The Monetary Policy Committee of the Central Bank of Nigeria on Tuesday raised the monetary policy rate, the benchmark interest rate, by 50 basis points to 27.25% in response to continued inflationary pressures. Now, this decision aligns with the MPC's previous actions, marking the fifth consecutive hike in interest rates under the current leadership. CBN Governor Olayemi Cardozo addressed journalists after the MPC meeting and emphasized the need for sustained efforts to achieve a positive real interest rate in order to attract investments and to improve the economy's competitiveness. He also noted that the bank cannot afford to relax its policy stance given the current economic conditions. Well, we are now joined on Newsday by Professor Uche Uwaleke, the financial economist and director of the Institute of Capital Market Studies in Nasarawa State in the University of Kefi, to discuss this MPC decision to hike rates and other measures that happened yesterday. Glad to have you join us today, Professor. Thank you for being patient.
Thank you so much. Thank you. My pleasure.
Well, did the hike surprise you in any way?
Yes, I was. I must say the outcome was contrary to, predictions by many analysts, including myself. I had expected that the MPC would hold the rates against the backdrop of the deceleration in inflation rates we saw in July and in August. Also on the back of the fact that in many economies today, the central banks are either cutting rates or holding rates. In the US, for example, we saw that the Fed began cutting rates. So I had expected that the central bank would follow suit by at least holding the rates. But that didn't happen. We not only saw an increase in the monetary policy rates by 50 basis points, we also saw the increase in the cash reserve requirement by as much as 500 basis points, from 45% to 50% for commercial banks, and by 200 basis points for merchant banks. Talking about 14% to 16%. So what that tells me is that the central bank MPC, must have information at its disposal that is not, it's not in the public space, and there must be something they know that we don't know, and it's on the basis of that I won't fault that decision. Now, number one, if you come to think of it critically, that decision was unanimous by all the 11 out of 12 members that attended that meeting. And if you also look at that communique gave a number of reasons why they chose to further tighten policy, beginning with the what they disclosed there, that the money supply is still on the rise. Banks are still awash with liquidity. And of course, the strong correlation, according to the bank's findings, the strong correlation between FAC releases and the level of liquidity in the banking system, which all of which go to also put pressure in the forex market. So I think the central bank is more concerned about the liquidity surface and the negative impact it's having on forex, in the forex market, on exchange rates. If you also notice, exchange rate has remained stubbornly high at over 1,600 naira, and I want to believe the central bank thinks a lot of that is happening because of the too much money that is chasing the little dollars that the central bank has. So I on that basis, as I said, I wouldn't fault that decision. I think they must have considered the balance of risks. whatever they have done must, in my view, must be evidence-based.
Now, Professor, the CBN governor, Yemi Cardozo, also talked about, all fundamentals being fixed. If not, he says Nigeria will continue to operate at a suboptimal level. So then I'm wondering, isn't raising rates again a bit punitive, especially to businesses, seeing as other fundamentals are not yet in place, or shall I say other fundamentals are not being put in place?
Yes, you're very correct there. But again, remember the point I made earlier that it would appear the focus of the central bank or the concern of the central bank is more with the pressure in the forex market. It's more on what is happening with the exchange rates, knowing full well that exchange rate also feeds into inflation. So that's why, in my view, the central bank is thinking that it should further reduce the ability of banks, to warehouse liquidity, as it were, and also to make credit, which is why the CRR, was also affected, by, as I said, by as much as 500 basis points. There's no doubt that the trade-off, would be there. Adverse consequences on production, consequences on outputs, and consequences on employment. We have seen the reaction of the organized private sector, the Manufacturing Association of Nigeria, in particular, NASIMA, Association of Small Businesses. Of course, they've reacted expectedly that the further hike will hurt outputs, will, of course, even jeopardize jobs, employment. Look at the recent employment figure by the National Bureau of Statistics. Unemployment is on the rise from 5 to 5.3% now, using their new methodology. So jobs are at stake. And the recent report I also read, part of why the organized private sector is concerned has to do with the number of companies, manufacturing companies that shut down in 2023, as over 750, again on account of high operating environment, high cost of inputs, high cost of finance, and so on. And of course, the forex issue too is one of that. So there is no doubt that this trade-off will be there. But again, you also look at it from the perspective of the bank. The bank thinks that interest rate is still negative. If you look at inflation rate at 2.15, and where MPR was 26.75, now 27.25, there is still, negative. And to that extent, of course, there will be a limit to which it can attract, capital flows. So central bank, wants to see how much it can also use that interest rate instrument to bring in a lot of forex to more like stabilize the forex market. And again, if you look at even the inflation numbers by the National Bureau of Statistics, what is on the decline is food inflation. Is because of the weight of food. Is the decline in the food inflation from 39%, about 39% to 38% in August. That was what led to the moderation in inflation rates. Core inflation, even over the 2 months, we have seen deceleration in inflation rates, July and August. Core inflation has been on the rise. So again, I think that is also part of the concern of the central bank. But my advice here is, given the adverse impacts on output, on jobs, and also given the concern of the organized private sector, it would be nice for the central bank to also not only communicate these measures properly, the rationale properly to this organized private sector, but also to bring them on board, to also make inputs to see how much cushioning can be extended to the organized private sector, so that the impact is not too much much on them, to the point where a number of them begin to lay off workers. That will be disastrous. And then what readily comes to my mind now is one thing the central bank can quickly do is to look at this issue of outstanding $2.4 billion that the outstanding $2.5 billion in forex forward contracts, areas that the central bank is has yet to clear. We understand a number of companies are already incurring huge losses as a result of the inability of the central bank to clear that. Central bank says such number of such claims are under investigation. So what needs to happen now is for the central bank to quicken whatever investigation that is being done on it, so that these obligations can be cleared, because that is what will also inject more confidence, in the economy, particularly in terms of forex forwards, because those are valid contracts that those people entered into. So the central bank should look into that. And talking about, again, the fallout, I also want to see a situation in which the central bank will also sit down with the fiscal authority, the fiscal side, the finance minister, budget, trade and investment, and then try to also come up with what needs to be done to ensure that whatever policies the central bank is taking to rein in inflation, particularly ensure that the exchange rate is stable, okay, doesn't have adverse consequences on the economy. As I said earlier, trade-offs, no doubt, you must have that, but how do we ensure that the adverse impact, okay, is more or less cushioned, such that the manufacturing sector can still breathe. If you look at the GDP numbers we are getting from the National Bureau of Statistics in terms of manufacturing, that of the first quarter of this year, for example, we saw manufacturing tank from 1.41 to 1.28%. So we need to stimulate growth, working jointly, both monetary and fiscal policies, working jointly to ensure that growth is not adversely affected as a result of the action of the monetary authority. So I've said a couple of things here, one of which is that the central bank should try as much as possible to clear the forex backlogs, the outstanding $2.4 billion. That will go a long way to boost confidence, especially now that we are witnessing accretion to external reserves. Part of what the CBN governor said was that reserves, foreign reserves have grown to $39 billion. $39 billion sufficient to finance 8 months of goods and services, and I think as much as 14 months of goods only. So we can say to that extent that external reserves will have sufficient external reserves to be able to not only clear those forex backlogs, but also to intervene in the forex markets.
And speaking of the central bank governor, Cardozo, he also talked about this, the dangers of this monolithic economy that we seem to have developed and the constraints that it puts on our exchange rate, as you've been talking about. How do you feel that the nation and the heavy thinkers within the country, how keen are they to move this needle and diversify this economy that has become a problem?
Yeah, thank you. Of course, that's a no-brainer, that except we diversify our export base, we are not going to get out of this challenge, the challenge of illiquidity in the forex market. The sustainable path to strong and stable exchange rate. When I say strong and stable exchange, I mean exchange rate that has a very low equilibrium price at 1,600 naira. Even if you stabilize exchange rate at 1,600 naira, the consequences will still be there. That I don't think that is what we desire. We desire a low exchange rate. So even if you're going to have stability, it should be around a low exchange rate, okay? Because that is what will make a lot of sense. That is what will not impact, so much on inflation. So it's the diversification of export base. And for that to happen, again, the two sides must have a handshake. The monetary and fiscal policies, must work in tandem, must work together. The fiscal side has a lot of role to play, no doubt, particularly in the agriculture, solid minerals, tourism, and other sectors that have the potentials to get us, this diversification. I'm aware that the accelerated stabilization plan of the government, has a lot in terms of, agriculture. So I think that implementation should be, expedited. I also think that the low-hanging fruit can also be leveraged. By low-hanging fruit, I mean even the crude oil that we produce here. If you look at the last GDP number again, I want to refer to it. It was the oil sector that powered growth. Oil sector grew by 10.5%. And that was even despite the slump in crude oil production to 4.4 million barrels per day compared to the previous quarter. So what it means is that if we can ramp up crude oil production to 2 million barrels per day, for example, you can imagine the kind of impact to have on the economy, on forex, and on macroeconomic stability. So we begin by ramping up crude oil production, attracting more investments in the oil and gas sector, and thank God Dangote refinery is now, has now come on board. But our local refineries too, need to receive attention. Okay, government should do something about revamping the local refineries to a point where they can now sell or put them in the hands of the private sector for more efficient utilization. So I think the fiscal side must look at some of the things they have done. There's nothing new we are saying here. Many of these things have been documented in National Development Plan, in the accelerated, and we have all manner of documents. So it is for the government to now implement them. Okay, particularly, I want to repeat, particularly in the area of agriculture. Agriculture contributes over 20% to GDP. Agriculture is a potential revenue earner. Agriculture too has a lot of job elasticity, job potentials to employ many Nigerians. Okay, the central bank can also assist, even though its primary mandate is monetary policy. It can also assist to pursue some of these growth objectives. All right. The development finance institutions, central bank should take it upon itself to ensure that the DFIs are strengthened. The Bank of Agriculture, the Nexim Bank, the Bank of Industry, okay, Development Bank of Nigeria. These banks should be strengthened to perform their functions, and the central bank can champion that, okay, because the way it is now, small and micro businesses cannot survive, cannot even afford to take commercial, loans from banks. So they need some sort of interventions, to be able to survive, and that is why we have development banks. Unfortunately, our development banks are weak, and that's why, I used to advocate to say that the central bank may also need to rethink its decision to completely withdraw from interventions, particularly in the agri space. But even if they say they want to withdraw and focus on monetary policy, that means the DFIs must be empowered to now fill that space, okay, so that small businesses can also have access to credit, because that is critical. Now, I was looking at if you look at the interest and environments of even countries around us in West Africa, you see that, yes, our monetary policy rate, 27.25%, is one of the highest. Okay, it's only Ghana that has 29% higher than Nigeria. But of course, in Ghana, inflation rate is around 20% now. If you look at Sierra Leone, look at Liberia, okay, these countries have interest, policy rates that are lower than that of Nigeria. And if you're talking of competition, you can't compete when your own is very high. Now, if you also look at the Central Bank of West African States, the one that covers the French-speaking, okay, Benin, Togo, Niger, Mali, Senegal, the French-speaking, the policy rates of that bank is just 3.5%. all right? And our own is as high as 27.10. So, but as I said, there's a reason for it. But again, if you look at their cash reserve requirements, for example,
Professor,
Nigeria's own is the highest at 50%, whereas you have in other countries ranging between 15 to 25%. Let me drop this before I go. That maybe the central bank should also consider linking the cash reserve requirement to loan-to-deposit ratio, okay, as we also have it in Ghana and some other countries, so that when banks lend to the real sector, you reduce their cash reserve requirements. That will serve as an incentive for more targeted credit to the real sectors of the economy.
well, financial economist Professor Uche Uwaleke, thank you so much for joining us on Newsday.